Now, before we jump into the refined product side, just want to remind you, please like, share, subscribe. Your support is very much appreciated and helps us keep growing the business and keeping this data flowing. So when we look at U.S. product supply, it's one of the reasons why we like to look at the rolling average and then just what we've seen overall. Because again, it gets lumpy, and that's where, like right now, just for the current, we saw a drop from last week. So last week, the total demand was 13.557 million. This week, it's 12.873. So again, we get that walk back. But when we look at the average, you can see it's really kind of flatlining. And that's where we keep talking about that 13.5 million is where we think is going to be kind of that right number. And just based on what we think is going to be the driver, it's going to be gasoline demand over the next, let's call it the next 4 weeks, is going to help pull that number higher because distillate is fairly flat. We think it's going to stay within this range. Jet fuel is going to remain under pressure, where really we think gasoline is going to give us that torque a little bit to the upside to just stay within that 13 million range, that mid 13 million range. Again, not enough to really send us back to where we quote unquote should be, but just it's some of that support to the upside. And then when we look at where we saw, so distillate stocks were essentially flattish. There was a small draw of 9,000 barrels. Right here, you can see where it was. We had the build of 1.3 million. Just pulling up the Excel sheet. So right here, you can see when we look at what we're seeing overall, yield on distillate is starting to go up a little bit, and we're going to talk a bit more about what does that mean as we see jet fuel stocks increasing exponentially, the demand really slowing down, and we just think some of that kerosene is going to end up within the distillate cut. So this is going to be something to watch, especially as the ARB continues to point towards the U.S. So typically the U.S. exports distillate into Europe. Instead, it's flipped, and the ARB makes sense to import from Europe. And we continue to see that. So we were expecting a bit more of a walk back, and instead we got an increase of 73,000 barrels a day into PADD 1, 44,000 a day in general. And you can just see the year over year and 5-year average, just how abnormal that really is. And it's really driven because right now just what is going to come going forward. So Europe refined fuel exports to the Americas are gaining momentum in early Feb. So again, seeing that momentum build. We saw it start to increase last week and the week before, and now we're starting to see that accelerate into early Feb. We have 3 Aframaxes capable of hauling about 80,000 tons. Each, and then an LR1 with about 60,000 ton capacity booked for loadings, about 300,000 tons of diesel from Europe to the Americas. U.S. diesel premium, again, remains over that European gas oil as it continues to widen. Just because, again, we see the diesel demand, we had some decent cold weather that's come through. And as we talked about as we'll talk about in the next segment, we're starting to see a bit more of heating demand. So again, imports will remain elevated. They'll walk back, but still be well over year 5-year average. And unfortunately, again, even though on the oil side, we're seeing a drawdown, we're now back within the cloud. We're not seeing the builds that we normally see, but at the same time, we're not seeing the draws we normally get in distillate. So when we look at that 29-year average, that dotted line, you can see that we normally dip well into April, and here we're just flatlining. And based on what we're seeing on the jet side with kerosene, the imports, the pretty much stable demand at this point, we think that we're going to start to see builds accelerate in distillate specifically, especially as we have kerosene starting to move into this market. Now, when we look at just demand, again, as we were saying, we thought we were going to go above the 5-year average, maintain above it. Here we are. It's still coming down a bit just based on the seasonal moves, the kind of those week over week moves as they get fairly lumpy. But again, we think it'll pull back just a little bit more, just as we've had a bit more of the Arctic weather pulling back a bit, especially as we go into the 14-day forecast. But again, these are things that are still going to remain robust, especially when we have trucking doing what it's doing. So again, our Expectation is at 105 to 115. We're at 127 on this trucking demand. So again, we think there will be a little bit of a pullback, but again, just showing that diesel remains robust in the market, continuing to see this pull through. As we'll talk again in way more detail in the economy show, we're going to look at PMIs, and not just the PMI, aggregate number, but really the breakdown. And we're seeing these delays remain in the shipping industry, in the transportation, which is going to keep a strong bid beneath trucking. And you can see just in terms of rates have normalized a bit, which again will help support some of the trucking data and trucking demand, as we do have truck availability essentially kind of flatline versus where it was in 2020. And load availability is starting to go up again. So again, we're starting to see a little bit more of this pull through. It's still early for us to take our spread higher, but if this load availability continues to push and make these highs for 2021, then 105 to 115 is just the wrong number, and it's going to have to go closer to 110 to 130 really, or 115 to 130, just based on how this demand is really starting to remain sticky. But while we're seeing this happen, we are seeing the rail traffic side. So when we talked last week, we were talking about total carloads. They're down slightly, down about 4.1% versus 2020. Chemicals is one that we think is going to stay fairly flattish. There's not too much to the upside downside. Coal is going to remain essentially under pressure, just because we still don't have gas to coal switching. So it just means that you're going to stay with natural gas, even at these prices, as it's rallied a bit. But farm and farm products continue to remain robust as we see some of this demand coming through. But when we look at grains is one that has that robust nature that's just going to remain. 43.4% year, this week versus 2020, very strong. Again, and we're going to talk in segment 5 of the Econ show, we continue to see purchases. We have, I think it's the second largest corn purchase ever by China, and I think the last one was 1977 by the USSR. So again, we're seeing a huge increase in demand going from the US into not only just China, but just into the world in general, which is going to keep grains going. And that'll pull more farm products. Farm products, when we're thinking about just in general what you need to increase acres planted, where farmers are going to start to prepare, they're going to start to get aggressive, and that's going to help support some of those levels. And as we were talking about, non-metallic, petroleum, motor vehicle parts, metallic, those are going to remain under pressure. We should see motor vehicle parts start to accelerate, though, just because we have a lot of drawdowns in terms of just inventory. We have had some companies slow down activity, specifically Toyota and Volkswagen, due to shortages of parts. So again, this is going to be a little bit of a supply issue, but that's one that's going to start to pick up, especially as companies look to rejuice their inventories ahead of the 2022 model year, which kicks off this summer. And then petroleum products remain under pressure. As we said last week, intermodal units pared back a little bit, but again, still up 7.6%, just because we do have that flow through coming on the coast and then getting from the coast. We do have a bit more of a normalcy on the inventory side, so you can wait a bit longer for the rail to pull in additional capacity versus trucking. So again, this is one, intermodal is going to remain elevated, not at the levels that we saw of 17%, 15, 17%, but in that high single digit, low double digit numbers. Now, when we look at the port, we just like to see what is happening overall, and we continue to see, going from left to right, from Jan 31 to Feb 20, you can see that there's been slippage out of the end of January into February, into the middle of February, where the issues at the port remain, and you're continuing to see these TEUs get stuck at anchor at the port, which is just delaying some of this offloading that is shifting it further and further into February. So when we first looked at this comes out daily. We had a big increase in Jan 31st through Feb 6th and Feb 14 to Feb 20. Now we're starting to see that push back. And the change percent versus previous week on Jan 31 is down 4.3%. And the increase on Feb 20 is that 29%. Again, you're starting to just see the difficulty in terms of getting some of this product on shore. Then when we look at weather, this is just something I think that we should start looking at a bit more. You can see that cold snap that's continuing through essentially over the next 6 to 10 days, and this is just going to increase the demand for heating oil, diesel in general, which will be supportive and again provide some of those tailwinds. So where rail is kind of flattish, based on expectations, trucking will remain robust. Heating oil will continue to be demanded as they backfill systems, as they pull through more product, which again is going to keep that diesel demand kind of firmly within that 5-year average and really just above that 5-year average. But then when we look at gasoline, there's a bit of a different story. So when we look at gasoline builds, they were built about 4.47 million barrels. It's still down year over year. It's down 9 million year over year. It's still below the 5-year average by 2.9 million. But what concerns us is the pace of builds. So when we look at that 29-year average, you can see, and even if you look at the 5-year average, it has that kind of natural build, and then we build into, let's call it early March, and then we start to see those drawdowns. Now the problem is the builds are accelerating and the pace is increasing, which is going to essentially take out that 5-year average. And now we're going to be above the 5-year average, and we're going to close the gap on that year-over-year change. Now, just to be clear, we were bearish in 2019 because storage was so high. So to still be below 2019 isn't really a good thing. It's just it's still a high watermark where we were bearish in 2019 because of because of those 2019 numbers. And now, those 2020 numbers, and now we're starting to close that gap. We had some, and this is even with some disruptions. So we did have some gasoline, facilities go down, which will help offset some of the builds next week. So it might take, instead of just being next week, it might take an extra week to close that 5-year gap. But again, the trajectory is there. We're not seeing the demand cycle pull the additional barrels through, even as we did see some yield come down and pare back a bit. But the bigger side is that blending component. So blending components is so important when we're thinking about octane and just general driving. So blending components increase in demand as we go into summer driving season because you have to use different components for gas at the pump. And you can see that we've now taken out the 5-year average. We're now above the 5-year average by 1.3 million. We're still below the year over year, but again, we're only down by 3.9 million. And that's going to continue to close as these refiners focus on summer grade and trying to capture some of that margin. Now, imports remain elevated. They were up 103,000, 88,000 into pad 1, 61,000 to pad 3. The imports of blending components remain elevated. Again, we're still down year over year, 5-year average, only because we have more demand for distillate imports at this point, just given the ARB and some of the demand that we talked about. So, but we still will continue to see those imports of gasoline as demand within Europe remains weak. And then when we look at, again, that product supplied, going back to 2006, where you can see that we're still below that cloud. We think that we're going to remain there, but again, drifting closer to the bottom of the cloud, where we think that 8.1 million barrels a day is kind of the right number as we go into March. And just looking at the demand cycle, as the weather gets warmer, as things get a little bit better, people feel a bit better about their situation. And just weather driven, you can see that we normally get an increase in demand from January into March, and this is something where you can see it on the bottom of the cloud as well. So the trajectory is up on the normal basis. So to see an increase from, let's call it 7.7 into, or 7.8 into 8.1 isn't a crazy number to see really come into the market. Again, it's going to be lumpy. This is something to watch, especially if the data continues to disappoint. Then we're going to have to rework, where do we think that total demand is going to be? But again, this remains a disappointing side of the equation. And it continues just based on where we're seeing, the U.S. data points on the high frequency side. So COVID cases continue to drop. Positive COVID deaths still remain elevated, which is really not, it's kind of the tail end of the COVID surge. Lockdown indexes are starting to come back, are starting to roll back a bit, which is a net positive. And it's going to take time to see the lockdown index start to come down and reverberate into the gasoline market. But again, that's one of the reasons why we think there's going to be a bit more of an uplift in general. So this is going to be a positive to see in general, and again, providing some of that tailwind to the gasoline numbers over the next few weeks. And then when we look at just Dallas Fed mobility and engagement, you can see we're remaining in this fairly tight range. And it's a range that we don't think is going to deviate too much, just because the benefits of gasoline or driving in general, we think will be realized more on the weekends, as we still have corporations not having people in the office. We're still seeing that difference between weekday and weekend. And that's where the days are in this called 60 to 65, and the weekends are 23 to 21 down below normal. And that's something where we think the weekends will get a little bit better, closer to baseline, where the weekdays will continue to be weak. And just to visualize that a bit better, when we look at the U.S. mobility and engagement, BNEF breaks it out between weekend, weekdays. So you can see that bounce in weekends. We think that continues to grind back to where we were in, let's call it September, just as we start to climb higher, but weekdays is continuing to roll over. Now, it's not that it's going to roll over too far, but we think it's just going to kind of flatline at these levels as workplace mobility by state flatlines and starts to decline a bit. Residential mobility is the one that's starting to creep higher, and we think that's going to be realized on the weekend numbers. So now, according to GasBuddy data, gasoline demand fell last week by 0.2%. The first weekly drop since the week of Christmas. Friday saw the highest daily demand since November 20th, while Saturday turned into the highest Saturday demand since the pandemic began. So again, there's some benefits, and we're starting to kind of normalize at these levels. And there's that timing delay. So we will see some of the demand get a bit better as guys went out and rushed to buy gasoline in front of the blizzard, or the nor'easter rather. So that will have to get replenished. So we'll start to see that data come through. But just as a reminder, that will be lumpy in general, especially as we look abroad. So when we look abroad, you can see that just economic activity remains a problem, especially as we have deaths increasing in some different locations. When we look at Japan, we've had that slowdown that's been realized as we continue to talk about South Korea and Japan going to multi-year lows in terms of just product imports, and product demand, as oil demand also comes under pressure, which is kind of offsetting some of the other pockets of growth. But again, we'll talk about why we think China and India will continue to slow and start to let's just say flatline at these levels. And here you can just see this just in general, France had a little bit of a recovery, which is a positive, but now they're talking about potentially lockdowns. So the next let's call it 5 days is going to be important to see what their decisions are. And then Italy is one that's going to be one to watch, and we'll talk about it in segment 4 of the Econ Show, as Conte lost his last attempt of trying to get a new government. They're now talking about bringing in Draghi to run the government and pushing for elections. So this is going to get very interesting very quickly. Now, turning back to the U.S. again, you can see just in general on that 7-day moving average, we continue to trend a bit lower on the retail recreation, on the grocery and pharmacy stores. Again, all of that is moving south, and that's going to be that headwind when we're thinking about weekday, weekend. Again, that weekday side of the equation is going to continue to be pressured as the demand for just that 5 days a week remains soft. And I just don't think there's going to be enough to make up for it on the weekends, especially as people look to adjust. And when we talk about adjusting, we'll wait to get to the chart on COVID before we talk about what is adjusting. Looking at Apple mobility trends, just to round it out, again, we're still below the baseline, but U.S. is hugging that level when we look at where we are, down, to call it 10%. Italy, Germany, U.K. continue to see an extension to the downside and really a limit to the upside as there's just pressure on the lockdowns and as COVID, cases start to normalize a bit, but still remain elevated as vaccinations start to roll out a bit more aggressively. But this is an important one. So as we talked about last year, we expected to see a surge in cases following the holiday, a drop in February, then an increase in March. And we're really seeing that come through as daily cases continue to drop like a rock, which is pulling current hospitalizations down, which is great. Deaths remain a bit stickier, but again, this is something that we think will start to follow that trend as well, because as it goes, cases spike first, then hospitalizations, then deaths. So it makes sense to see cases drop, hospitalizations drop, then deaths drop. But when we're thinking about what people are doing, there's still some caution as to what normalization we'll see. And that's why, daily tests remain elevated, which is a positive, people being proactive, and then it's still resulting in less cases in general. So we're seeing those averages move down. But as people start to get, not to say lulled into a sense of false confidence, but as people start to normalize a bit, that's where, and then if you just think about change of season, March is typically a big month. So that's why we think we'll get a spike in March. It will not be the spike that we saw during the holidays. It won't be 1 for 1, but it'll just be another kind of that last push higher before we see that drop off and continue through not only the spring, but into summer. And when we look at cases here, you can see cases flatlining overall. The U.S. is in a positive trend. Europe is that flat line, which is that problem that we keep talking about. Asia Pacific has seen a bit of an increase depending on what country we're talking about. India is moving in the right direction, and we're starting to see some lockdown indexes go lower as they're starting to open up a bit more, and we'll talk about that in segment 5 of the Econ Show. Japan is dropping, which is a positive. South Korea has hit a sticking point, so that's one that we're going to talk about a bit more in the Econ Show. But we're still seeing, so that's just going to limit some of the movements. We're still seeing those headwinds in terms of just activity in the country. And again, this is just going to be important for where are these products moving. Because even though we're seeing some of that oil drawdown, we're seeing those product builds and struggling to find a home given some of these demand factors. Now, vaccinations are obviously the key at this point. We're seeing the UK continue to drift higher. We're seeing them get fairly aggressive in terms of getting those first inoculations. The second one is the problem in terms of some of the data points. U.S. has flattened out a bit. That should start to kick back up, given we're using the log scale. The problem is the rest of Europe still remains fairly slow getting this, off the ground. And some of the data points that have come out from some of the vaccinations are showing a bit less efficacy than were expected, which, again, not a huge surprise given it's coronavirus. They mutate pretty quickly. But the fact that it's been able to show some sort of capacity to mitigate against the South African strain, the UK strain is a positive, and then if they want to target those directly, they talk about it. I think it was Moderna who said it would take about 6 to 8 months to again target that one, which is just means that we can continue to move and adjust. But it just also shows that this is going to be a vaccination that's going to have to remain with us, on a year-by-year basis. Right now, they're talking about a booster every either 6, 8, or 12 months, depending on the company, which just means that this is going to be something that we'll have to deal with for a period of time until it becomes hopefully a little less deadly or problematic and just becomes part of the normal flu, the flu season, if you will. But again, these are just going to be a net positive as we start to see these rollouts in general. But on the jet side, we had that big build of 1.79 million. The year over year, we're still down small, but we're now above the 5-year average. This is going to remain under pressure as you can see that huge demand drop. We had a lower high, now we have a lower low. And again, this is why we think we're going to be around this, let's call it that 750 to 850 level, maybe push back above 1,000, but just given how quickly the drop has come, we don't think we're going to get back above that 1,000 or that million over in the next few weeks, especially with what's happening in China. So there are there's about 1,450 fewer departures on average. China flights have declined rapidly, again, leading to some of those issues that we're going to talk about in segment 3. Around 10% of scheduled flights there have been canceled over the next 40 or so days. China Southern appears more affected, with almost a third of the flights canceled. Cuts will appear in general, so you can see that huge drop. But even in the U.S., we've seen those reductions in general. This is going to just be inherent pressure on production, which is why we think you're going to see a bit more of a push into the disti cut, as even the yields remain fairly elevated at the refining side, which means that the kerosene is going to just end up in the disti pool in general, which is going to be a headwind as we go forward, because China is not going to reverse anytime soon. And then pressure is going to remain within Europe and the US. So again, there's going to be no real place to export it. And there's just going to be very limited demand in the US, which again is going to keep that distillate storage starting to get elevated, especially as we start to see that the jet storage or kerosene storage increase. They're going to have to get kind of creative. And as they focus on it, creating more octane, kerosene, a percentage of it can also go into the octane pool. So that these are things that we're going to have to look at in general to appreciate where do we go next on some of these demand levels, because again, oil drop coming down. But when we look at the oil draw and the product builds, we actually had a net build in the US, and that's where we continue to see those problems. And when we look at TSA passengers, again, we're within this tight band. We came a little bit lower at 493,000, but again, this 550 to 750 is just where we think we're going to sit, especially where we could take it a little bit lower depending on if we continue to see the deterioration. We think that, again, we're at an extreme right now, and we'll start to see some normalization. So this tight band is kind of where we think we're going to be for the next few weeks. And here it's just when we're looking at grounding, commercial flights are running at less than 60% of comparable levels in 2019. So you can see 2019, 2020. So the trend is going in the wrong direction. If you look at 2020, it went in the wrong direction before. So again, we're not seeing too much of an abnormal move. Open table, again, data remains problematic. We don't see this changing all that much. New Jersey is increasing some of their capacity from 25% to 35%. We think that'll start to happen as, again, some of these cases come down. So we think on a global level, we're going to see some of those, when we look at the weekends are getting a little bit better. And that's where we think we're going to see some of that weekend activity, mobility, as we talked about, versus the weekday. So the U.S., we think on the weekends, we're going to see something closer to down, 47 to 53%. And on the weekdays, we think we're going to be able to maintain between that 60 and 65%. Everything else remains locked down. Ireland, Germany, Canada, UK, there's not much to say there's going to be too much of an adjustment. Australia slowed a bit, but again, that's going to be those headwinds that are going to persist into the coming months, again, which is going to be that overarching problem when we think about how quickly can we normalize, where is that demand going to come from? And we just continue to see headwinds on a net level, where gasoline will provide some uplift, but it's going to be muted. Diesel is going to remain fairly stable. Jet will remain under pressure. Residual fuel will remain fairly flattish. And again, that's going to keep us well below seasonal norms, and is going to keep that, oil is going to continue to draw down, but those products are going to continue to build, creating those issues that we see persisting much longer than I think what the market is looking at in general. Now, in the next segment, we're going to look at exports, the international market in a bit more detail, to appreciate what comes next and where is the futures market versus the physical market, because they're telling two different stories.